72 hours to reset. Fed rate cut meets Treasury crisis. The Fed just cut rates and Treasury yields exploded higher. The 10-year hit 4.60%, the 30-year touched 4.80%, and bond prices are collapsing. We're now 72 hours from Treasury auctions that could determine whether the dollar survives this decade. If these auctions fail, the Fed will be forced into emergency QE, the dollar will crater, and gold will blast through $5,000. This is the reset everyone feared, and it's happening right now. This isn't a normal rate cut cycle. This is a collision between Fed policy and bond market reality. The next 72 hours will decide the trajectory of rates, inflation, and your portfolio for the next 5 years. Hit subscribe right now, because in 48 hours, I'm releasing what assets survive the reset. Make sure notifications are on. Let's go. Here's what most people don't understand. The Fed controls short-term rates, but the bond market controls long-term rates. On December 18, 2025, the Fed cut the Fed funds rate to 4.25% to 4.50%, a 25 basis point cut intended to ease financial conditions. But instead of falling, long-term Treasury yields spiked. The 10-year Treasury yield jumped 15 basis points in the week following the cut, hitting 4.60%. The 30-year yield climbed to 4.80%, a 3-month high. This is not normal. When the Fed cuts rates, bond yields are supposed to fall. So what's happening? The bond market is rejecting Fed policy. Investors see what the Fed refuses to admit. The U.S. Treasury is facing a structural funding crisis. With $36 trillion in total debt and annual deficits running at $2 trillion, the math no longer works. At an average yield of 4.5%, the U.S. government is paying roughly $1.6 trillion per year in interest, about 80% of total federal tax revenue. 4 out of every 5 tax dollars goes just to service the debt. This is fiscal dominance, when debt service becomes so large that monetary policy is dictated by the need to keep the government solvent. The 72-hour countdown refers to the Treasury auction schedule. Between January 6th and January 8th, 2026, the Treasury will auction tens of billions in 10-year and 30-year bonds. If these auctions show weak demand, measured by a bid-to-cover ratio below 2.0, it will confirm that foreign and institutional buyers are stepping away. That's when the Fed will be forced into emergency quantitative easing to prevent a sovereign debt crisis. This is bond vigilante territory, markets punishing fiscal irresponsibility by demanding higher yields. Retail investors were told that Fed rate cuts are good for bonds. Buy TLT, buy AGG, buy bond funds. Rates are coming down, easy money. But that narrative just exploded. While retail piled into long-duration bonds expecting a rally, institutions were shorting 30-year treasuries, buying gold and rotating into hard assets. The unfairness is in the information asymmetry. Wall Street knew this was coming. Meanwhile, savers are getting crushed from both sides. Deposit rates at banks are falling as the Fed cuts, but inflation remains sticky above 2.5%. Real yields on cash are negative again. The system punishes prudence and rewards leverage until the leverage breaks. Let's look at the data. In the week after the December 18th rate cut, the 10-year Treasury yield rose 15 basis points, from 4.45% to 4.60%. The 30-year yield hit 4.80%, the highest since September 2025. More troubling, foreign demand has collapsed. According to Treasury International Capital data, foreign holdings of U.S. Treasuries fell in October 2025. China, which once held over $1.3 trillion, now holds less than $750 billion and continues to sell. Japan has slowed purchases significantly. In Q4 2025, foreign buying of treasuries was down approximately 50% year over year. Meanwhile, the Fed's balance sheet stands at around $7 trillion, down from the COVID peak of $9 trillion, but to absorb weak auction demand and prevent yield spikes, the Fed may need to expand by $500 billion or more. That's stealth QE. The timeline is critical. Fed cut December 18th, yields spiked December 19th at 20, and now we're 72 hours from the January 6th-8 auctions. If bid to cover falls below 2.0 and indirect bidders drop below 60%, the market will interpret it as a failed auction, and yields will explode higher. Now, this pattern has played out before. In September 2022, the UK faced a gilt crisis when Prime Minister Liz Truss announced unfunded tax cuts. Gilt yields spiked, pension funds faced margin calls, and the Bank of England was forced into emergency bond buying within 48 hours. Truss resigned within weeks. In 2024, Japan's yield curve control policy broke when the Bank of Japan could no longer cap long-term JGB yields despite massive intervention. Yields spiked, the yen collapsed, and inflation surged. In 2001, Argentina's sovereign debt crisis triggered currency collapse, bank runs, and economic depression. The pattern is always the same. Fiscal irresponsibility meets bond market discipline. Yields spike, auctions fail, central banks intervene, and the currency pays the price. The U.S. has avoided this for decades because of dollar hegemony. But with de-dollarization accelerating, foreign buyers disappearing, and deficits out of control, the bond vigilantes are circling. Signal 1, watch the January 6th to 8. Treasury auctions. Watch bid-to-cover ratios on the 10-year and 30-year. If they fall below 2.0, it confirms weak demand. Also watch the percentage of indirect bidders, foreign central banks. If that drops below 60%, it signals foreign flight. Signal 2, watch for the 10-year Treasury yield to break 5.0%. 5% is the psychological level that triggers cascades. Mortgage rates will spike above 8%, refinancing will freeze, housing will crash, and the Fed will panic. Signal 3, watch for emergency Fed QE. The Fed won't call it QE. They'll use terms like liquidity support or market functioning, but it's debt monetization. Watch for the Fed balance sheet to expand above $7.5 trillion. Signal 4, watch gold. Gold is currently around $4,400. If it breaks $4,500 and holds, it confirms that smart money expects currency debasement and a dollar crisis. The fundamentals are clear. $36 trillion in debt, $2 trillion annual deficits, collapsing foreign demand. At 4.5% average yield, interest costs are $1.6 trillion per year, 80% of federal tax revenue. This is unsustainable. The only ways out are cut spending dramatically, raise taxes massively, inflate the debt away, or default. Options 1 and 2 are politically impossible. Option 4 is unthinkable. That leaves option 3, inflation and currency debasement. This is fiscal dominance. The Fed's policy is now subordinate to Treasury funding needs. The Fed can't let yields rise too high, or the government goes insolvent. But it can't suppress yields without printing money, which destroys the dollar. Risk 1, long duration bonds. The 30-year Treasury is down more than 40% from its 2020 peak. Bond ETFs like TLT, BND, and AGG are at multi-year lows. If yields spike to 5%, those bonds will lose another 15%, 20%. Risk 2, cash and savings. With Fed cuts, deposit rates are falling, but inflation remains above 2.5%. Real returns on cash are negative. Risk 3, stocks. If Treasury yields spike above 5%, stocks will crash. The equity risk premium collapses when risk-free rates hit 5% plus. The hedge, short duration treasuries, 1 to 2 year, gold, Bitcoin, foreign currencies, and hard assets. The Fed is telling you everything is fine. Soft landing, controlled cuts, inflation under control. The bond market is screaming crisis. Yields rising, auctions weak, foreign buyers gone. The media focuses on the Fed while ignoring the Treasury crisis. This is psychological warfare. Keep the public calm while the system unravels. Don't fall for it. Follow the data, not the narrative. Scenario 1, 45% probability. Auctions stumble. Bid to cover falls below 2.0. Within 2 weeks, the Fed announces emergency QE. Yields fall temporarily, but the dollar crashes. Gold spikes above 5,000. Bitcoin rallies, inflation expectations explode. Scenario 2, 35% probability. Yields break 5%. Stocks crash 15% and 20%. The Fed pauses cuts or hikes to defend the dollar. Stagflation, high inflation, rising unemployment, collapsing growth. Scenario 3, 20% probability, auctions clear with decent demand. Yields stabilize temporarily. Crisis delayed to Q2 2026. Timeline, 72 hours for auctions, 2 weeks for Fed response. Q1 2026 will be decisive. The Fed cut rates and Treasury yields exploded. We're 72 hours from auctions that will determine whether the dollar survives. Watch 4 signals. Auction results, 5% yield, Fed QE, and gold above $4,500. Exit, long bonds, hold short duration, and hard assets. Subscribe now for What Assets Survive the Reset, dropping in 48 hours. Comment below, what's your 72-hour positioning?